Right. Welcome to our session for this weekend. We'll start today and then we'll continue tomorrow in the morning. So please note that we'll continue tomorrow. Today, my main focus is on PPE and investment property. So I'll be focusing on the second question. Then later today, I will send what we shall focus on tomorrow. As tomorrow, I would also want to incorporate fair value measurement within what we are going to be doing. So please make sure that you prepare yourself for the test that you'll be writing. And you should note that they can even bring in other concepts from the other topics that we have already done. Anything can come from whatever you did from the beginning of the year up to now. It can be examined, right? So let's go to the question 2. Right. Cape Cafe Limited is a restaurant group based in the Western Cape. The company is a 30 June year end. So we now know that our year end is 30 June. As I said, your year end is very, very, very important, as it will give you the demarcation line when you are determining things like depreciation, accumulated depreciation at end of year. When you determine the months and the years, your year end will be very, very crucial there. Of course, we also need to know the specific year end. Right. Then we are told that disclose the following notes to the annual financial statements of Cape Cafe Limited for the year ended 30 June 2018. So we now know that our specific year is 30 June 2018. So we need to do the PPE and the investment property. Don't worry about the non-current assets held for sale. Don't worry about the non-current assets held for sale. We'll only deal with the PPE and the investment property. Right. Then we also want to do the deferred tax also today. So we'll also do the deferred tax. Right. After we've done the deferred tax on this one, I want you to go back to the question 1 that we did together on Tuesday and try to also do the deferred tax of that one. Right. So before we answer the PPE, we can also go through the accounting policies. The following is an extract from the accounting policies of Cape Cafe Limited. Right, accounting policies are very, very important because they will determine how we determine things like depreciation, how we calculate things like deferred tax. Right. Owner-occupied land is accounted for in accordance with the revaluation model from the current financial year. So that means it was never revalued before. So they are going to use the revaluation model from this current financial year. So that means before current year, it was at cost. Right. Owner-occupied land was previously accounted for in accordance with the cost model. Right. Revaluations will be made in future with sufficient regularity to ensure that carrying amounts do not differ materially from that which would be determined using fair values at the end of the reporting period. It is company policy to realize revaluation surpluses through the sale of the underlying assets. Right. That one will affect the deferred tax. I will explain it when we do the deferred tax, the second part of deferred tax, that last statement of realizing revaluation through sale. Right. Then the second one, owner-occupied buildings, equipment, and delivery vehicles are accounted for in accordance with the cost model. Investment properties are accounted for in accordance with the fair value model. Then depreciation on buildings and equipment are accounted for in accordance with the straight line method over the estimated useful lives of the asset. So that's buildings and equipment, we're using the straight line. And then depreciation on delivery vehicles are accounted for in accordance with the units of production method. So for motor vehicles, we'll use the units of production method. Right, so those are the policies. Any questions on the accounting policies? Maybe something that you don't understand there on the accounting policies. All right, the taxation part, we are going to deal with it when we read it, when we do the deferred tax. Then also you should know that the assumptions, land and buildings are regarded as separate classes of assets. So we don't combine land and buildings. We treat them as different assets. So land and buildings will be treated as different assets. We will not take them as one. Right. Now let's go back. Remember what I said. You have to take each asset one by one, and then you do your calculations. Right. First of all, we've got the property in Cape Town. Then we've got the property in Franschhoek. Right. We first have to see, and then the property in Kensina. So we have to understand if all of them are PPE. Remember that a property is PPE if it is owner occupied. And if it's rented out, it's investment property. Right. So we start with the property in Cape Town. On 1 July 2014, Cape Cafe Limited purchased the property located on ERF 722 Cape Town at a cost of 2,130,000. It was available for use as intended by management, as well as brought into use on this date. Remember, the day when an asset is available for use, that's the day that we start to provide for depreciation. Right, according to the terms of a 5-year operating lease agreement, 25% of the floor space of the building is leased out for 55,000 per month. Right, there's a portion of the building that is being leased out. There's a portion of the building that is being leased out. Right, the remaining 75% of the floor space of the building is used by Cape Cafe for their own purposes. So that means we've got a building that has got dual purposes, partly rented and partly used. Right. Then the directors of Cape Cafe consider the 25% of the floor space of the building to be an insignificant portion. Right. Remember, the portion that they are using is supposed to be treated as a PPE, whilst the portion that is being rented out is supposed to be treated as investment property. But if it is considered to be insignificant, so although they are renting out 25% of the building, the whole building will be taken as PPE, as long as the other portion is considered insignificant. The same, if the one that they are occupying was considered insignificant, the whole building was going to be investment property. So in this case, since the portion that they are renting out is considered insignificant, this whole building will be considered to be PPE. Right. The building has an estimated useful life of 25 years and a residual value of 270,000. On 30 June 2018, management revalued the land for the first time. On this date, an independent sworn appraiser determined the fair value of the land to be 950,000. On 30 June 2018, it was determined that the remaining useful life of the building remained unchanged, whilst the residual value of the buildings increased to 570. No decision has been made by the company to sell this property. Right, so the property in Cape Town, it's PPE, since the portion that is rented out is regarded as insignificant. Right, property Franschhoek. Right, during the previous financial year, Cape Cafe Limited decided to expand their operations to Franschhoek. On 1 September 2016, Cape Cafe Limited acquired a property located on ERF 458 Franschhoek at a cost of 1,520,000 and opened a restaurant there. The building was available for use as intended by management on 1 November 2016, as well as brought into use on this date. Right, so that one is PPE, okay, because they are using it as a restaurant there. So it's owner occupied. The building is an estimated useful life of 20 years and a residual value of 180,000. On 31 May 2018, Cape Cafe Limited sold the property for 1.7 million. Land and then building, because the location was not suitable for a restaurant. Right, so then it was later sold during the current year. Remember, our year is ending 30 June. So on 31 May, we should remember that we've got a disposal of this property. And this property is PPE. Property Kensina. On 1 May 2017, Cape Cafe Limited acquired the property located on ERF 968 Kensina at a cost of 2.5 million, with the intention to earn rental income from it. So as long as your intention is to earn rental income, then this is investment property. This is investment property. So for now, let me leave the investment property because we're going to start with the PPE. Right, so let's do our calculations. Right. Land. Right. Right, we've got two pieces of property. We have one in Cape Town. Then we have one in Franschhoek. And then our total. Remember that the property is not investment, it's investment property, it's not PPE. Right. So we've got the carrying amount at the beginning of here. Right. Remember at the beginning of the year, they not yet revalued any property. All revaluations were told that they only began during the current year. Right. Right. So we have here, the Cape Town property was bought for 780. And by the beginning of this year, remember they adopted the revaluation model during the current year. So it was the first time to revalue it. And the Franschhoek, it was 520. So it was 780 and 520. Right. Right. Then we have revaluation. Right. The revaluation. Right. We're told that on 30 June, management revalued the land for the first time. On this date, an independent sworn appraiser determined the fair value of the land to be 950. Right, there was no revaluation on the Franschhoek as it was now sold. So that means this Cape Town property, it had moved its value from 780 to 950. So your revaluation will be the difference. And revaluation is treated as other comprehensive income. Less 780.
Yes, Eugene. I just want to check something on the revaluation. Is it when we're saying revaluation surplus or fair value adjustment, is it the same thing?
No, on land, we say on land, on PPE, that's when we use the revaluation. Fair value adjustment, we use it on
land,
on investment property.
Or investment property, okay.
Yes.
Okay, no problem. Thanks.
Thank you. Right, what do we get? 170. Then we have disposal. Remember the Franschhoek was then sold. If an asset is sold, we remove it from our books. Then we get our carrying amount at the end of year. Any questions on the land? So that revaluation of 170 will be treated in case you are doing the journal entries would debit the land and credit the revaluation. And revaluation is treated as part of other comprehensive income. We don't recognize it immediately in income. It will only be transferred. It will depend on the policy of the company, but normally they transfer when the asset is finally sold. Right. Any questions? Then we'll deal with the buildings. All right. We'll start with the carrying amount at the beginning of the. But let's start with the cost, because these are calculated, it's not the formal. Right. The Cape Town, the cost was 1,350. And the Francois, the cost was 900. So with 1,350 and 900. Right. Then we get our accumulated depreciation. On 30 June 2017. So please, guys, first of all, you put a break on 30 June 2017. Why? Because we need the carrying amount at the beginning of the year. Remember, our year is ending on 30 June 2018. So we first have to find the carrying amount at the beginning of the year. We need that calculation, because when we do our PPE note, we would need the carrying amount at the beginning of the year. Right. So let's go back to the Cape Town property. Right. We know that our Cape Town property is estimated, it had an estimated useful life of 25 years and a residual value of 270,000. And it was bought on 1 June 2014. And it was available on the same day. Is that right? That you should not just check when it was bought. When we are determining depreciation, we need when it was available for use. So by 30 June 2017, from this date, it was exactly 3 years old. From 1 July 2014 to 30 June 2017, it was 3 years old. And the residual value is 270. So to calculate our depreciation, would say 1,350 minus the residual value. We always subtract our residual value if we're using the straight line method. Right. Then divide by the number of years, which is 25. Then we multiply by 3. The 3 is for the 3 years from 1 July 2014 when it was bought up to our beginning of year. So we're ending on last year, 30 June 2017. In the front of property, we're told that the building, all right, this one is a particular case that I was talking about. You can see that it was acquired on 1 September, but it was only available for use on 1 November. So we will start to provide the depreciation from 1 November when it was available for use. Right. And we know that it had a residual value of 180 and a useful life of 20 years. Right. So by that time, by the beginning of the year, from 1 November 2016 to 30 June 2017, that will be 8 months. 1 November 2016 to 30 June 2017, the end of last year, it is a end of, when I say last year, I don't mean last year 2022, I mean last financial year, because our financial year, we're assuming that we're on 2018 year. So up to 2017, 30 June, that will be 8 months. Right. So would say $900,000 minus 180,000 over 20 multiplied by 8 divided by 12. What do we get? $170,000 and 129,600. Thank you so much. Where is the 24,000? Maybe I'm making a, is there an error there? I see another 24,000. Or maybe I took a wrong amount. This 170, isn't it?
I think you swapped them around, sir.
The 129,600 is supposed to be here. And this is supposed to be 24,000. Is that right? Thank you. Thank you so much, guys. Then we get our carrying amount at the beginning of here. Any questions so far? Right. Then we have depreciation for the year. There are two things that you have to be very careful. So when you read your question, you should take note of those things. Number one, on the Cape Town property, there was a change in the residual value. It now yet once they said what it was determined that the remaining useful life remained unchanged. Once the residual value increased to 570. Right. When there's a change in the residual value, we apply IAS 8. That is a change in accounting estimate. Now, according to IAS 8, a change in accounting estimate is applied prospectively and not applied retrospectively. When we say it's applied prospectively, we mean we don't have to adjust the previous year. Adjustments will only be for the current year going forward. Right. So what does that mean? That means from now on, we will use the new residual value, but our useful life will now use the remaining useful life so that we don't affect the ones that are already gone. So we know that this property had a useful life of 25. And by this year that we are changing the useful life, 3 years have gone. So we're left with 22. So we'll now provide over the remaining 22 years. So we'd say, and we no longer use the cost. From that moment, you no longer use the cost, because if you use the cost, it will affect the retrospective application. So you would say, so I want you to be very careful with me and be with me here. So the Cape Town will no longer use the cost of 1,350. We'll use the 1,220,400. That is the carrying amount at the beginning of the year that the change happens. Then minus the new residual value, which is now 570,000. Then we don't divide by 25, we divide by 22. Where is the 22 coming from? Remember, the useful life was 25 years, and 3 years, if you can check here, 3 years had already passed in the previous, from 2014 to 2017. So we're now left with 22 years. So I want you to understand this. When there is a change in accounting estimate, whether we're changing the residual value or we're changing the useful life, according to IAS 8, that change is applied prospectively, not retrospectively. And to allow for prospective application, we will no longer calculate the depreciation based on the cost. We will now be calculating the depreciation based on the carrying amount at the beginning of the year. And we will no longer use the original useful life. We will now use the remaining useful life from the beginning of the current year. From the beginning of the current year. Right. You should know that there is no clarity in IAS 8 on when, if you decide to change, let's say at the end of the year, from when should you effect that change. There is no clarity in the standard. But the UNISA approach that they are taking, as long as we made a decision this year, whether we made it at the beginning or at the end, that change is taken as if it came into effect from the beginning of the year. So you can see that I'm saying that because you can see that this change in residual value, they did it at the end of the year. So someone might ask, they did the change at the end of the year, so why can't we calculate the current year's depreciation without taking the change into account? So the approach of UNISA, if there is a change in the useful life or a change in the residual value or change in depreciation method during the current year, whether at the beginning or in between or at the end, we'll take that change in policy as if it happened from the beginning of the financial year. So that means, although the decision was made on 30 June, we will take the residual value as if it had been determined from the beginning of the year. Right. So a residual value. Remember what we talked about that, I think, was it a week or two ago? When we talked about the residual value, when we said the residual value, it's an estimate. You'll be estimating what you expect the value of your asset to be at the end of its useful life. So there are various factors that have to be taken into account when you are estimating. So it's an estimation. So there can be, for example, improvements in technology that can render your estimate to be wrong. So you can re-estimate it. Not necessarily by an appraiser. You can even do it by management or someone who is within the entity. But normally the things of land, that's when we say there should be an expert to revalue that. But determining the residual values, it doesn't necessarily need someone who is an appraiser. Right. Then for the France of property, there's also an issue. The France of property was then sold on 31 May 2018. So that means it was not available to us for the whole year. It was available from the beginning of the year, which is 1 July 2017, up to 31 May 2018. That means it was only available for 11 months. 1 July 2017, which is the beginning of the financial year, up to 31 May 2018, which is 11 months. So this property was only available for 11 months. Right. So we would calculate its depreciation. We would say 900,000 minus 180,000 divided by 20, but then we multiply by 11 divided by 12.
Hi, Eugene.
Yes.
Was it not available on the 1st of November?
Oh, it was not. No. Remember that we are now in 2018. That 1st of November, it affected this this one here, my sister. This 8 months. Do you remember?
Okay, so
we're now in the current. This is depreciation for the current financial year, the 2018 financial year. It was there from the beginning of the year, 1 July 2017.
Oh, no, I understand. All right.
Is that right? This one is now for the current financial year. So by the beginning of the financial year, it was already within the entity.
Understood, sir.
Thank you, my sister. Right. So what do we get here? Okay, so I think I saw someone gave us the other figure there. Sorry. I saw the other giver, 52,882. Thank you, Roshan. 52882. Then the other one, 29564. Right. Then remember, the front stock was now sold. A disposal is recorded as carrying amount. A disposal is recorded as, yes.
I got 29564 for Cape Town.
Yeah, that's correct. This is a correct one.
29564.
29564. Yeah.
And this one?
And then it's 33,000.
Thank you. Are we agreed now? Right, your disposals, we don't record the disposals at selling price of the asset. We record them at carrying amount. That is the cost minus accumulated depreciation. So it will be the disposal will be the 876 minus 33. So when you are doing your PPE, my friends, there is no way where we record the selling price of the property. That it was sold for 1.7. We don't even need that when we are doing the PPE. The selling price, we need it when we are doing maybe the P&L, because we would need to report on the profit or loss end or realized on the or incurred on the sale of the property. So when you're doing your PPE note, you don't even need the selling price of an asset. What you just have to know is when was it sold, then you just provide for depreciation up to that date. Right. Then we get our carrying amount at the end of the year. Right. Those are our calculations on the building.
Is the 843 for disposal a positive figure?
No, this one is supposed to be negative so that we get 0, ne? Negative sum. Thank you. What I mean, right. Right. Thank you. Right. Before I proceed, any questions? No questions. Right. Mtanden.
Yes, Eugene, I have a question on the carrying amount at year end or at the end of the year. Are we not supposed to have that recon underneath there, where we have the cost?
Remember, we do my voice name, but remember here we're doing calculations. We're not yet doing the
Oh,
the
yes,
note.
not the notes. Not the notes. Okay, okay, yeah.
So
Yeah.
we'll come to the note. And when we do the note, we'll definitely need that.
Okay, okay, yeah, okay.
Thank you, my chief. Right. I will not talk about this property for Kensina at the moment, my friends. Since we said this is an investment property because their intention was to earn rental income. So that one I'm going to talk about it after we finish the PPE. All right. Kitchen equipment oven. On 1 April 2016, Cape Cafe Limited purchased an industrial oven for 118,800. The oven was transported to Cape Town at a cost of 10,400 and was installed and tested at an additional cost of 9,500. The purchase price, transport, and installation costs were immediately settled in cash. The oven was available for use as intended by management, as well as brought into use on acquisition date. Right, my friends. Okay, just give me, can I just have 1 minute? I just want to get some water. Sorry, just 1 minute. Right, my friends? Sorry. What I was saying here, we're talking about the acquisition of this oven. Remember, there are costs, additional costs that are incurred when acquiring an asset, which are supposed to be added to the cost of the asset. And we also have other costs that are not supposed to be added. I think we covered that last week. Right. Transport, installation are costs that are supposed to be added to the cost of an asset. So this 10.4, when we consider the cost of this asset, we're going to include the 10,400 and the 9,500. And you should know the ones that are not supposed to be included, things like advertising, the new asset, cost of training the employees to use the new asset, initial operating losses before the asset can reach profitable levels. All those costs you are not supposed to include them. So we're going to take the cost as 118,800 plus 10,400 plus 9,500. Right. The oven was available for use as intended by management, as well as brought into use on acquisition date, which is 1 April 2016. And it was before the current financial year. Remember, our current financial year started on 1 July 2017. Right. On acquisition date, an estimated useful life of 4 years and a residual value of 15,500 was allocated to the oven. Right. Then on 1 June 2018, management decided to sell the industrial oven in the next financial year because of the high maintenance cost thereof. In future, the Cape Cafe Limited will rather rent a suitable industrial gas oven, stove and oven from a reputable supplier. The residual value and the expected useful life of the oven remained unchanged throughout the period. Right. When you decide to sell an asset and you've made a commitment at the appropriate level, and you are now actively marketing the asset, from that date, when all criteria is met, that asset will no longer be treated as PPE. It has to be shifted from PPE to what we call non-current assets held for sale and accounted for in terms of IFRS 5. Right. So this oven, has to go to non-current assets held for sale. Right. That is from right. They said what all criteria were met on 1 June, from 1 June. So up to 1 June, we are going to apply the principles of IS 16, property, plant, and equipment. That means we depreciate it. If there's a test of impairment, we do the test of impairment up to that date. Then after that, we will no longer apply IFRS IS 16. Right. The sale of the oven is expected to be completed by 31 July 2018 for cash. The fair value less cost to sale of the oven on 1 June 2018 and 30 June 2018 were estimated to amount to 70,000 and 65,000. Right. So let's deal with the oven. Right. Our cost would have 118,800 plus 10,400 plus 9,500. What do we get?
One 700.
It's what?
138, 700.
Okay, thank you. Right. Then we have accumulated depreciation. At beginning of year. remember that this asset, it was available for use on acquisition date, which is 1 April. And by the end of last year ended on 30 June 2017. 30 June 2017. That means it had been used for exactly 1 year and 3 months. From 1 April 2016 up to 30 June 2017, it's 1 year and 3 months. 1 April 2016 up to 30 June 2017, the end of the previous financial year, it's exactly 1 year and 3 months. Right. And the useful life is 4 years. Residual value is 15,500. So to calculate our depreciation, we're going to say 138,700, 138,700 minus 15,500. Then divide by the useful life, which is 4 years. Multiply by, remember we said 1 year and 3 months. That is 15 months. 1 year is 12 months plus the 3 months is 15. Divide by 12. What do you get? $38,500. Then we get our carrying amount. It's beginning of year.
Sorry, Mr. Eugene.
Yes, my boss.
Did you just say they divide by 4 times 15 divide by 12?
You said what?
They by the accumulated depreciation. You said 138,700 minus 15,500 divided by 4 times 15 divided by 12.
Yes.
Where do you get the 15 from again?
1 year, 3 months. It's 15 months.
Oh, okay.
Whenever your period is not full years, convert it to months, and then you divide by 12 to convert it to years. Remember that is divided by 4. That is the depreciation for the 1 year. So we have to multiply by the number of years. So the number of years is 15 over 12. That it had been used up to the beginning of the year.
All right.
That is from 1 April. If you check here, my brother, we're saying our last year ended on 30 June 2017. So it started on 1 April 2016. So 1 April 2016 up to 30 June 2017, that's the 15 months. Right.
All right.
Then we'll have our depreciation for this year. Depreciation for this year, it will be remember that it was only from 1 June 2018, it was no longer PPE. So only depreciate it up to 31 May, which is 11 months. From the beginning of the year, 1 July 2017 up to 31 May 2018. So that is 11 months. So our depreciation for the current year will only depreciate up to 1 June, which will give us 11 months. So would say the 138,700 minus 15,500 divided by 4 multiplied by 11 over 12. What do we get? $28,233. Then we get our carrying carrying amount on 1 June 2018, when all criteria for reclassification were met. Right, then we compare that carrying amount to the fair value less cost to sell. No, there's no change in useful life here. There was a change in the residual value. Here, there's nothing that changed. It's only that it was sold. It was it's changed from one subject. Okay, our colleague is asking why didn't we use the carrying amount? We said we use the carrying amount when there's a change in accounting estimate. For example, if they change the residual value, if they change the useful life, that or the depreciation method. But here there's no change. It's only that they've decided to sell. There's no change in anything, the other parameters. Right, so we still use the original cost price. As long as there's no change, our depreciation will be based on the original cost price. Right, then in terms of IS 36, we are going to do it in detail in our next, in the preparation for our next assignment. I think these ones will just be assignments. I think those are the topics that we'll be dealing with very soon. You have to compare the fair value less cost to sell to the carrying amount. Right, the fair value less cost to sell was 70,000, and our carrying amount is 716,967. So when carrying amount, we'll do it in detail later, is more than the tax base, more than the recoverable amount. There is impairment. Right, the recoverable amount is the lower, is the higher, sorry, of the fair value less cost to sell and the value in use. Right, so like in this case, our carrying amount is 71967. Right, we are not given the value in use, so automatically our recoverable amount will be the fair value less cost to sell, which is 70,000. So our carrying amount is now more than the recoverable amount. So we have to reduce it to the recoverable amount by accounting for what we call the impairment loss. So there is impairment loss. So there is impairment loss if the carrying amount of an asset is now more than the recoverable amount, and the recoverable amount is the higher of the fair value less cost to sell and the value in use. So in your exams or tests, if we only know the recoverable, the fair value less cost to sell, that means it automatically becomes the recoverable amount. Or if you just know the value in use, it automatically becomes the recoverable amount. Right, what do we get? I think this one is straightforward. Then we'll have our transfer to non-current assets held for sale. As I said earlier on, this abbreviation that I've put here is allowed. Non-current assets held for sale. That will be the 70,000. Right, from the moment that in assets is all criteria for is being held for sale are met, from that date, that asset has to be moved from its current category to non-current assets held for sale. Right. Any questions? No questions. We'll move on to the next asset. Delivery vehicle.
Sorry, Eugene.
Yes, my boss.
Can I ask?
Yes, you can.
On the impairment, can you go back on the impairment loss? You said that when it's vice versa, when the residual value is more than the carrying amount. Can you explain that again, please? Sorry.
I said when the carrying amount is more than the recoverable amount, there's an impairment loss.
Yeah. No, that one I understand. But I'm saying if it's
No, I didn't
vice
talk
versa.
about the other side, but it's good to talk about it, but I never mentioned it. The
Oh,
other
okay.
side, we don't record anything.
Oh, okay. We leave it as it is.
As long as the carrying amount is less than the recoverable amount, it's fine.
Okay, thanks. Then.
So as long as your carrying amount is more. But if we previously recognized an impairment, maybe in the previous year, then we come to this year and you find that your carrying amount is now less than the recoverable amount, then you have to is now more than the recoverable amount, then you will have to reverse the previously recognized impairment. But for now, I would guess let's not talk about it. It might even bring more confusion because it's one of the topics that are for the next assessment,
Okay.
which we're going to deal with, I think, yes, from this coming week going forward. It's a current asset. Non-current asset held for sale, it's a current asset, it's SFB sale. Actually, when we transfer, we'll debit the equipment, we'll debit the non-current assets held for sale, which is SFP, and credit equipment, which is also SFP. So it will be an asset, but it's no longer a non-current, it's now a current asset. Any other questions on the equipment? Right, let's move forward. Let's go on the delivery vehicle. During the current financial year, management decided to expand their operations by including a takeaway option at their Cape Town restaurant. On 1 February 2018, Cape Cafe Limited purchased a small delivery vehicle for 140,000 and to deliver the ordered meals to customers. The delivery vehicle was repainted at a cost of 6,000 after acquisition to advertise the restaurant group. The delivery vehicle is to be serviced every 15,000 kilometers and the service cost is estimated to amount to 2,000 per service. The delivery vehicle was available for use as intended by management as well as brought into use on acquisition date. On acquisition date, an estimated useful life of 150,000 kilometers were allocated to the delivered truck, whilst the residual value was determined to be 50,000. The delivery vehicle traveled a total of 10,000 kilometers during 2018 financial year. My friends, number one, I will talk about the repainting to advertise the restaurant. According to IAS 16, when you acquire an asset, the cost of advertising the asset, like repainting, these are costs that are considered to be, they should not be capitalized, they are expenses. So we will not add that cost to the cost of the asset. So the 6,000 will not be added to the cost of the asset. Right. Then the delivery vehicle is to be serviced every 15,000 kilometers. Repairs and maintenance of an asset are not capitalized. Repairs and maintenance of an asset are not capitalized. They are treated as expenses. So this amount will also be treated as an expense. Is that fine? Right. Then another thing that is very important, depreciation are accounted for in terms of the units of production. When they use depreciate on the vehicles units of production, that means we depreciate it according to the kilometers, traveled. So okay, let's start on our delivery vehicle. Cost. So our cost will just be the 140,000. Right. We don't have accumulated depreciation at the beginning of the current year. Why? Because this delivered vehicle was acquired during the current financial year. They acquired it during the current financial year. That means from the previous years, they didn't have vehicles. Right. Then next, we calculate our depreciation. And they said they are using the units of production. In this case, the units are the kilometers traveled. During the current year, they traveled 10,000, whilst the expected was 150. And we also have a residual value of 50,000. Right. So our depreciation for the year would be the cost, which is 140,000, minus our residual value, which is 50,000. Right. Times the number of kilometers traveled, which is 10,000, divided by the total estimated number of kilometers, which is 150,000. Right, my friends. The fact that it was acquired on 1 February 2018, that means it has only been there for, by the end of the year, remember our year is ending in June, it's only 5 months. If they were not using the unit of production, we're going to multiply by 5 over 12. We're going to multiply by 5 over 12. But when we use the unit of production, the number of months are not important. Depreciation is not based on time. It is based on consumption or and usage of the asset. So depreciation, when we're using the units of production, is based on usage. We can even use an asset more in 1 month. Let's say we're in the construction industry and it's raining. We are not using the truck. It will be stationary. We will not be using it. Then when the rainy season is gone, you will now use it more. So when we're using the units of production, please remember that the number of months are not important. We're only interested in the usage of the asset. So although it was used for 5 months, we're not going to multiply by 5 over 12. So always when you're using the units of production method, you ignore the months. You only deal with the usage of the asset. So hence we are just multiplying by they used 10,000 kilometers. So 10,000 over the total useful life, which was 150,000. Right. What do you get? $6,000. Thank you so much. Then we get our carrying amount at end of year. Any questions? Right. My friends, let's say they said there is a major service. Major service. A major service will be taken as part of PPE. But normally it will be depreciated separately. Think if they talk about major service, if they talk about a component, a major component, or major repairs, they are no longer the ordinary repairs that are expensed. Those ones will be taken as part of PPE. So they'll be capitalized to the asset. So when you see major repairs, major service, major component, you should know that it will be part of the property, plant, and equipment. Any questions? Right. So then we can now do the property, plant, and equipment. A total is not required. Right. So let's do the note. Extracts of the notes to the financial statements. Of what's the name? Cape Cafe Limited. For the year ended 30 June 2023. I will share it, Mr. Benjamin. Don't worry, I will do it today. Most probably before 5. Yes, I'm already in 2023 here. I'm forgetting that we have gone back to 2018. Sorry for that. Right. So we have land, buildings, equipment, vehicles. The total, they said they don't need it, but remember that I told you that I will no longer do the total. I already showed you how to do that. So that's where now we have to show the cost and the accumulated depreciation. I think you heard the gentleman asking earlier on. Right. So here now we are supposed to show the carrying amount at the beginning of the year. Cost accumulated depreciation. Right. Our land only has cost. It was 1.3 at the beginning of the year. Please, I want you to check as I highlight the figures that we are taking there, so that when you are alone, you don't get confused. So our carrying amount, it was 1.3. And remember that on the land, there is no what? Depreciation. There is no depreciation on the land. Right, on the buildings, please just be checking my screen so that when you are alone there, we had our cost was 2,250,000 at the beginning of the year. And our accumulated depreciation was the 153,600. That's the accumulated depreciation at the beginning of the year. So you'd see that, as I said, that if your calculations are organized, it will be very, very easy for you. So you just be referring to calculation 1, calculation 2, and stuff like that. Your equipment, our cost was 138,700. And our accumulated depreciation is also following here. This 38,500. Then our delivery vehicle, remember, it was bought during the current day, so it was 0. Any questions? Right. Then revaluation surplus during a remember that our land was revalued by 170. That's the only asset which was revalued. And normally that's the only asset that we normally revalue in our modules. Right. Additions during here. There was no land that was acquired. There was no building, no equipment, but we bought a delivery vehicle for 140. We bought the delivery vehicle. Right. Then depreciation for the year. There is no depreciation on the land, but on the buildings, we had depreciation for the year of this one here, the combined for the Cape Town in Francois. Then on the equipment, we also had depreciation for the year. This one here. On the vehicles, we also had depreciation for the year. This one here. Any questions? Right. Impairment loss during the year. It was only on the equipment. Remember, we found that the carrying amount of 71,967 was now more than the carrying the fair value less cost to sell of 70,000. So there was impairment of 1967. Then we have disposal. Right. Remember, we sold land. The property in Francois was sold. So we had a disposal of 520. Then on the building again, the same property. Right, so that is the only asset that was sold. Then our equipment, we transferred it. When we transfer an asset, so it has to be removed from PPE. So that is equal to so this is a summary of the transactions that took place, the changes that took place during the year. Any questions? Right. Then we will now find our carrying amount at the end of the year. We now have to determine our carrying amount at the end of the year. Right. Right. There will be cost or gross carrying amount. Right. We always use this cost or gross carrying amount if there is an asset which was revalued. Remember, we have a land that was revalued. So we only use this if there's an asset that was revalued. Right. Then accumulated depreciation. Right, on the lands, we are only left with one property, the one in Cape Town, which is for 950,000 at the new value. And still there's no depreciation. On the building, we have our cost here for the building in Cape Town. Remember that the one in Franschhoek was sold, so our cost will only be the Cape Town one. Then our accumulated depreciation, or maybe you can say cost at end of year. You say okay, let me just mention that this is buildings. Cost at beginning of year. At the beginning of the year, our cost of the building was 2,250. Right. Then a cost of assets sold. Remember that the asset that was sold is the property in Franco. This property at the cost of 900,000. Then add cost of additions. If there are any assets that were bought during the year, of which we don't have, then we can get our cost at end of year. So you get this sorry, this one is less. So that's where the 1,350 can come from. So that's our general formula for any asset. If you want the cost at the end of the year, especially you use this, you go to this complication of calculation if there were assets sold or assets sold and assets bought to avoid errors there. But if there's nothing bought, nothing sold, you don't have to, especially if there's something is sold. That's why we have this complication, right? Then we have accumulated depreciation. At end of year. You say accumulated depreciation at beginning of year. We know that this was what? No, not this one. This one here. Right. Then add depreciation for the year. The depreciation for the year, it was this one here. Right. then less accumulated depreciation on disposals. Right. Remember thank you. No. Here we're adding. Sorry. So sorry about that. I think here I should put the my 153,600 here. Okay, we'll just put it as a negative that side. Then our accumulated depreciation on disposals, which was this one here, it had a depreciation of 24,000 and 33,000. 24,000 and 33,000 here. So we add them together. What do we get?
57,000.
That way we get our accumulated depreciation. So this might be necessary if there are any assets that were bought and sold during the year, especially if there's an asset sold. Because if there's an asset bought, there's no complication there. So that means this one will be negative 159,164. But for this one, it was going to be very easy. It's only that I'm just showing you so that in general, if there are many assets. But for this one, it was going to be very easy. We're not going to have to do all this because we know that there was only one property, which is the Cape Town that was left. So we could know that our carrying amount is 1190836. So we'd come here and just put our carrying amount here 1190836. Then find the difference between the costs, this one. Then we get this one without even doing this calculation. But you only use that if you know that there's only one asset left. So I was giving you this formula because you might have maybe 4 properties and one is sold. I can't understand the question that is being asked today. This one is just a calculation of the accumulated depreciation at the end of year. Where you add or subtract is here. That's where it is necessary to subtract it here. But here we're just calculating to just find out what is, yes.
I don't know if you can hear me because there's like music in my background. But on your calculation there, accumulated depreciation at the beginning of the year is a positive. Add depreciation is a positive. Less accumulated is a negative. So now I don't understand why is the other one negative and the other one is positive.
The one on the disposal will be taking it out. When you sell an asset, you remove its depreciation.
Oh, all right, I get it. Thank you.
Remember that every year, when you provide for depreciation, whatever depreciation you provide will be adding to the depreciation that we already have from the previous years to make up what we call the accumulated depreciation. Is that right? When we say accumulated, we mean added up. Is that right? That's accumulating, isn't it? So every year, the depreciation for the year will be topping on the one that we already have from the previous years. So from the previous years, we have 153,600. Then we added this one for this year. But then when you sell an asset, you have to take out all the records about that asset. You take out the cost, the cost is taken out. You also take out its accumulated depreciation because we no longer have that asset. We don't need any records about that asset within our books. Is that right? Because the accumulated depreciation that we want here is the accumulated depreciation of the assets that are existing at the reporting date. So here we're taking out the accumulated depreciation that way it was in the books on the asset which was sold, which we no longer have. That's why I had to subtract it there. Any other question? our equipment is 0. Remember that it has been transferred here to non-current assets held for sale. We no longer have equipment. Our vehicles, the cost is 140. There's no need to do many calculations there. Then our accumulated depreciation is this one here. So that's it. But then we are supposed to state information about if there's any revaluation about our land. The land that was revalued is this one here, okay, which is located here. Then it was revalued by an independent zone appraiser. Right, so you would say the land and buildings are situated at that's ERF 722 Cape Town, and were revalued on 30 June 2018 by an independent zone appraiser. Right, the carrying amount of the land, if it was carried at cost, would have amounted to, right, if it had been carried at cost, remember that it could have been still at 1,780,000 the original cost price. 780,000 the original cost price. 780,000. So this last statement is unnecessary if there's no revaluation. So that means it's a requirement that if there is a revaluation, we should show what could have been our carrying amount had we not used the revaluation model. Any questions? No questions. Right. So that's it on the property, plant, and equipment. I think here I should write the heading always there. That's number 1. We can say property, plant, and equipment. Right. Right. I would go now to the investment property. The second note that they told us is to do the investment property. Right. Or maybe at this moment, can I just give you a 5-minute break so that you can just relax a little bit? I'll give you a 5-minute break. We'll just start it around 22. Just take a 5-minute break. I'm not going to go out of the meeting. By 20, I think it's 27 by 22, then we start. Right. Now we want to do the investment property. With the investment property, the entity can choose to either use the cost model. The cost model is the one that we've been using on the buildings, whereby we provide for depreciation. So when they are using the cost model, whatever we're doing on the land and buildings on PPE will be exactly the same way that you account for the investment property. So there's no difference. So that's why I don't have to repeat the way of cost model. So when the investment property is the cost model, exactly what we did on PPE will be what you will do on the investment property. But you find that in most of our tests and examinations, instead of the cost model for investment property, they usually use the fair value model. Now, if they are using the fair value model, there is no depreciation. Actually, at the end of this each period or periodically, it can be after 2 years, after 3 years, it's not necessarily a year, you find someone who is qualified. So this one is the one that usually IS 40 requires you to make sure that the revaluation is done by someone who is able to, who is qualified to revalue such buildings, so that we can ensure that our financial information can be relied upon. So now, when we use the fair value model, the person comes, let's say at the end of the year or at the end of 2 years, assesses the building, tells you that your building is now 5 million. Then if it was 4 million in your books, then you increase it to 5 million. Any increase on the investment property is what we call fair value adjustment. Any increase in our investment property is called fair value adjustment. Or decrease, it can be also a fair value adjustment. Right. An increase, unlike a revaluation which is taken as a part of other comprehensive income, an increase in our investment property is taken as income in the statement of profit or loss. So it goes to P&L, not to OCI. An increase in our fair value adjustment of our investment property is income. It doesn't go to to other comprehensive income. It's part of income. So it's a P&L item. Right. Then if it reduces, it depends. If there were any revaluation, fair value adjustment increases in the previous years, any decrease will be written off against such increases that were recorded in the previous years, up to the maximum of the revaluation that was already there. Right. Let me just explain an example. Let's say we bought a building in 2020, and then it was we bought it for 1 million. Right. Then by the end of 2020, it had increased to 1.2. That means the fair value adjustment is 200,000. This will be treated as income. Then in 2021, remember it's starting at 1.2, the closing for 2020. Then if the qualified person comes and says your building is now 1.7, sorry, not 1.7, let me say 900. The fair value adjustment will be 300,000 decrease. And this one will be regarded as an expense. So if it goes up, it's income. If it goes down, it's an expense. No provision of depreciation. Right. So in this particular case that we have, remember that investment property is any property that you are renting out. And even if you also buy a property for capital appreciation, that's also investment property. Let's say you are just watching the market. If it goes up, you might even sell it. But if you are trading in land and buildings, they will no longer be investment property. They will be infant, which you treat according to IS2. Right. And also, if you buy land whereby you have not yet made a decision on how you are going to use it, that land will be considered to be investment property also. Right. So this one, the intention to earn rental income. So it will be taken as investment property. Right. The fair values, since we're using the fair value model, they were determined by an independent sworn appraiser. That means last year it was 1,210 and 1,480, and this year it was 1,410 and 660, whereas the original cost was 2.5. Yeah, right. So when we record our investment property, so that would be number 2, investment property. We'll have our land, we'll have our buildings, we'll have our total. Right. Then we start with our carrying amount at the beginning of the year. Carrying amount at the beginning of the year. There is no need for us to record our costs. There is no depreciation here. So our carrying amount at the beginning of the year will simply be the fair value that was there at the beginning of the year. All right, so it will just be there, a fair value that was there at the beginning of the year. If we check on our question here, that means from last year we had 1,210 and 1,480. So there's no need to go back and record the cost price. We just need this carrying amount at the beginning of the year. That's what we're going to record. Right. So that is 1,210,000 and 1,408,000. Then we get our total. That will be our carrying amount. So there's no need for you to write costs and stuff like that when we are using the fair value method for investment property. But if we're applying the cost model, you also do the same. That cost are less accumulated depreciation. Right, then we have your fair value adjustment. Our current year, right? We are told that by the end of the year, the independent sworn appraiser determined the values to be these ones. So we have to record that movement. So saying 1,410,000 minus 1,210,000. Then we'd also say 1,660,000 minus 1,480,000. What do we get? $200,000. So I'd say 200,000. If it's a decrease, you subtract. If it's an increase, you add. And 180,000. Thank you so much, guys. Then you get your carrying amount. So there will be no depreciation. End of year. Right. Then considering that there was a revaluation, we are also supposed to state that the valuation was performed on 30 June 2018. By an independent. You can just change the wording or whatever, but as long as it's bringing in whatever I'm writing here. And normally for investment property, there's no need for you to go on and say the carrying amount could have been. You can just leave it like this. So that's our note on investment property. So we find that in most of our tests and most of our exams is one of the easiest notes to do. Actually, you just have to be very careful when you are now calculating the deferred tax related to the investment property, as you shall see when you calculate deferred tax. Any questions there? And please don't forget what I told you the other day, that instead of them asking you to prepare the investment property or the PPE, you can be given the PPE. Then you just ask to comment. So you should also be prepared to explain the principles that I'm talking about, instead of preparing to be able to explain what should be used and what identify any errors in a note that has already been prepared. And I know that I don't usually do that, because I know that as long as you have prepared, you now know how to do it. But maybe tomorrow I might find one question that deals with that area, so that you can be able to see the line of answering them, if you are given already. Right. Any questions on the investment property? All right. Then the last question that we're going to do for today calculate the deferred tax balance on 30 June 2018 of Cape Cafe Limited, only relating to the Cape Town Kensina properties. Right. They only said we should deal with the Kensina properties there, but I'll just deal with all properties. I'll just deal with all property, all assets that we have in this question. All right. Calculation. Calculation of deferred tax balance on 30 June 2018. My friends, you need these things here. I think I've already taught you these ones. The things that are required. We need our carrying amount. We need our tax base. We need our temporal difference. We need them deferred tax. Right. Remember that we are dealing with assets. And let's remember our rules. That for when we are dealing with assets, if our carrying amount is greater than the tax base, there is a deferred tax liability. Then when carrying amount is less than the tax base, then we've got a deferred tax asset. These are the basic rules for assets. I will not talk about liabilities, but at the moment we're just dealing with assets. So that means for you to determine whether there's a deferred tax liability to asset, you have to, for each asset, we have to have the what? So we'll start with the Cape Town property. our land. Remember the carrying amount of the land, we just take it from our PPE for our, it will be the 950,000. Then our tax base will be the original cost price. SARS does not take into account any revaluations that we record. So it will be the original cost price. Now, if you can check, the original cost price of the Cape Town property was 78. So that would be 780,000. Right. Then our temporary difference would be the 950 minus 78, the difference between our carrying amount and tax base. Then you multiply by your tax rate to find our deferred tax. So you have to check your tax rate. Please check your tax rate on Monday, because these days some papers they are now using the new tax rate of 27. So please check. Don't just assume that it's 27 or 28. Some papers they are saying 28, some 27. So in this case, we are assuming that is 28. The CGT did not change; it's still at 80. So that's 28%. So you then multiply to get your deferred tax. You multiply your temporary difference times the tax rate. So that is equal to this one. Okay, can you just give me this figure? Okay. Right, this is a liability. Why? Sorry. I think I'm making a mistake here. I forgot something that the principle to tell you the principle. I'm just thinking that we're dealing with buildings. Right, for land, whether investment property or PPE, the deferred tax arising from revaluation should be calculated by also taking into account the capital gains effect. That would be capital gain, an increase in your assets like this. So instead, on the land, deferred tax on the land, we're not going to multiply. Let me just show it here. It will be the 170,000 multiplied by 80%, multiplied by 28%. Why? Because when we realize that gain, SARS will only takes 80%. The inclusion rate for CGT purposes is 80%. So for land, always remember to calculate your deferred tax, multiply by 80% and by 28%. Sorry for that earlier failure to take that into account. So can you give me what we get here? Would have 38080. Thank you, guys. And note that this is a liability. Why? Because the carrying amount here of an asset is more than the tax base. So it's a liability. Any questions on the land? Right. Then the building. The carrying amount, will get it in our PPE note. Right, now let's determine the tax base. Please let me just specify here so that when you're alone, you can be able to follow. Right, to calculate your tax base of the building is the cost Right, our cost of the Cape Town building was 1,350. Right, less our building accumulated building allowances. These are the allowances that are, when we're calculating our tax base, we subtract the allowances according to SARS. According to SARS. And when you are doing this module, don't just assume that, okay, from tax 3761, it's like this. We know that it's by our 5%, but you should go and check where they talk about tax and check if they are providing for what capital allowances on this particular building. Remember, there are some buildings that SARS does not grant a capital allowances. Right, we are told that there's a 5% annual building allowance on all buildings that we have in this question, and according to the straight line, and not apportioned. Not apportioned. So that means even if there's part of a year, we're not going to apportion. So if it's 3.5 years, you take as 4 years. 2 years, 1 month will be 3 years. Right. So it's 5%. And we know that this building was acquired on 1 June 2014. And for tax purposes, we don't use the ready for use. We start from the date that the asset was brought into use. For tax purposes, we don't use the date when the asset was ready for use. We use the date when it was brought into use. So here we're told that it was available for use as intended by management, as well as brought into use on this date. So it was available on 1 July 2014. So from 1 July 2014 to the date that we're determining our deferred tax, which is 30 June 2018, that's 4 years, exactly 4 years. 1 July 2014 to 30 June 2018, the date that we are determining our deferred tax, they are exactly 4 years. So we'd say 1,350 multiplied by 5%, multiplied by 4 years. So please, you can go and try that one that we did where I left the deferred tax, that other question. What do we get here? 270,000. So that is 270,000. Then we get our deferred tax. So not deferred tax, tax base. $1,000,008. So this one will be 1,000,008. Then our temporal difference will be this minus that. Then our deferred tax, Cape Town building, would be the difference that we got, 110,836. As long as there's no revaluation, it will just be at the tax rate. As long as we don't have revaluation, it will just be at our tax rate of 28%. What do we get?
So if there is revaluation,
Hello?
Eugene, tell me.
I can't hear you. Set 1034. Thank you. And it's a liability again.
If there was revaluation, were we going to subtract?
Like we're not tested on that anymore on the valuation of buildings, but there could have been a portion that could have been subject to CGT, like you will see when we deal with the investment property. So the way that I'm going to do on the investment property building, that could have been the same way here on this building also. But these days they no longer test you the revaluation of buildings. They just do the revaluation of land in terms of PPE. Can I move on? Right. Before I move on, I want any questions on that Cape Town property.
Mr. Eugene,
Yes, my boss.
the 170, it's the temporary difference of the land.
Yes.
Are
When
you
calculate the
calculating?
deferred tax, you use the temporary difference.
Come again?
When you are calculating your deferred tax, you apply your tax rate on the temporary difference.
Oh, okay. And what about the issue of the above base and the below base tax?
For land, remember that we are saying the land, there is no depreciation, so we don't have that. If unless if the fair value of the land is below the cost price, that's when we use the 28%. Of which in our modules, the land, they always test us with the land above the original cost price.
All right.
Right. Actually, that portion I'm also going to talk about it when we deal with the investment property, because there are issues there. Right. The France of property is no longer there. Remember that it was sold. On 31 May, they sold it. So we are not going to talk about it. Right. Then we'll talk about this property, Kensane. Right. Our land. The carrying amount will be the one that we have on our note here, 1,410. And the tax base will be the original cost price. Original cost price, which was what? 1.1. So the tax base will always be the original cost price on our land here. Because SARS does not grant allowances on the land. Then the temporary difference. Right. Then our deferred tax. We'll take, so for the land, for the investment property, we do the same. Multiply by 80%, multiply by what? 28%. What do we get? So land, whether it's investment property or PPE, the application will be the same. Right. 69440. Thank you so much. Then buildings. The carrying amount we have it here. Right. Your tax base, you calculate it again. Because we've been told that SARS, they are providing. So the fact that we are using the fair value model, it has nothing to do with SARS. SARS, they use their own ways. They don't care about how we determine our depreciation. Right. Our cost. Remember, they said 5% on all property was 1.4. Then accumulated building allowances. Right. We know that it was brought into use the building was brought into use on 1 June 2017. So we don't use the 1 May 2017, 1 June 2017. Right, by the end of this current year, it now had 1 year. Remember that our year is ending on 30 June 2018. So it now had 1 year and 1 month. 1 year and 1 month. So our building allowance, remember, is not apportioned. So that 1 year and 1 month will be taken as 2 years. That 1 year and 1 month will be taken as 2 years. So I would say our accumulated building allowances would have times 2 years. I guess you'd get 140 there. Because that would be 10%. Right. Then we get our tax base. Right. So that would be 1260. So please, SARS does not apportion. Right, that is the part now that I'm coming to. Let me just do it somewhere here. I'll also call your calculations here. My friends, you should be very careful when you calculate the deferred tax. On investment property. Right. The temporary difference above cost price will take into account the CGT consequences because it represents a capital gain. So we're going to say the carrying amount minus cost would multiply that by 80% times 28%. Then the temporal difference below cost would be at 28%. So be very careful when dealing with an investment property, the building. So that would be the cost minus tax base. This one will be at 28%. There will be no 80%. So you calculate it in 2 parts. Right. Remember that the costs were given here. 1.4. 1.4. The carrying amount, we have 1660, then 1260. So to calculate our deferred tax here, we're going to say 1660, the carrying amount, minus the cost 1.4. This portion would multiply by 28%, by 80%, then times 28%. Then the other portion, we are going to say 1,400,000, the cost minus the carrying out the tax base 1,260,000. This portion would multiply by 28% only. So this first part is this part here. Then the second part is this part here. So you calculate your deferred tax in 2 parts. Why? Because there's a portion that will take into account the CGT and there's a portion that will not take into account the CGT. So please be very careful and make sure that you understand and know how to determine this part. What do you get? What do you get? Right, thank you. 9744. So that would be negative 9744. Right. So please, you should be very careful. There any questions there on the deferred text of the right. Then next, don't be tired so early. The kitchen equipment, the oven. Right. So our answer was supposed to end here, my friends. That was the answer. So the originally, please, that's the answer, that's the end. Then you just add up the last column. But because we are not in that exam, we can go further now and finish off all the other assets. We have the kitchen equipment. Please also note that SARS does not take into account our residual values. So when you calculate tax allowances, don't include the residual values. SARS does not take into account our residual values. Our residual values are only for the sake of determining depreciation in our own books. Right. The kitchen equipment now, the carrying amount on 30 June, that is the fair value less cost to sell on 30 June, which is 65,000. It will now be 65,000 on that date. But SARS, they don't care that you are holding it for sale. They will just treat it in the same manner that they always do. Let's see if they gave us the right. It takes allowance on equipment according to the straight line method over 6 years, and it's apportioned for part of the year. Then we're also told that transport and installation costs of the oven will be regarded as of a capital nature. When they say that, that means SARS are also adding the transport and installation, like what we did, to the cost of the asset. When they say they are not capitalized, then you know that SARS are not adding those two to the cost of the asset. But in this case, since they say they are regarded as of a capital nature, that means they are also added to the cost of the asset. And remember that the section 11E allowance, it's apportioned, but you should also check the instruction. It's apportioned. That means we'll take into account demands. Right. So we'd say our kitchen equipment oven. Equipment oven tax base. Cost. The cost we calculated it earlier on. It's 138,700. Then accumulated wear and tear. Right. Our accumulated wear and tear. Remember that this equipment, so SARS, they don't mind that you are holding it for sale. They just take it as your asset as long as you are still having it. Right. It was acquired on 1 April. Is that right? But when was it brought into use? It was brought into use on acquisition date. So it's 1 April 2016. So if you say 1 April 2016 up to 30 June 2018, 1 April 2016 to 30 June 2018, when we are doing these calculations, it's exactly 2 years and 3 months. 2 years and 3 months. 1 April 2016 to 30 June 2018 is 2 years and 3 months. And when we convert that to months, so we'd say 138,700 divided by 6, because they said SARS is providing the allowance over 6 years, multiply by, we said it's now 2 years and 3 months. So 2 years, it's 24 months. 2 years is 24 months plus the 3 months is 27. Divide by 12. What do we get? Thank you. 52013. So that's 52013. Then we get our tax base, which will be 86687. So that will be 86687. Right. Then our temporal difference, we find the difference. Right. Then our deferred tax, this one will just be at 28%. We'll just take that value that we have, the difference, 21687, multiplied by 28%. What do we get? Thank you. That's 6072. Right. So here we would have 6072. That's an asset. That's why it's positive here. Why? Remember, we said when the carrying amount is less than the tax base. Here, our carrying amount of 65 is less than the tax base of 86. So our deferred tax is an asset because it represents a future deductibles. Right. Then we have the delivery vehicle. Our cost, our carrying amount, we have it on our PPE note, which is 184,000. And our tax base, we have to go and check what SARS are saying about delivery vehicles. A tax allowance on the delivery vehicle according to Section 11E of the Income Tax Act, according to the straight line method, over 4 years, apportioned for part of a year. So it's 4 years. And remember that this vehicle was bought at 140. So, and they are providing over 4 years. And it was SARS, if we're using the units of production, they don't mind about their units of production, the kilometers that we're using. They will just use their 4 years. And they will start on the day that was brought into use. They said that the delivered vehicle was available for use as intended by management, as well as brought into use on acquisition date. On acquisition date. So that acquisition date, that was on 1 February 2018. So it'd say tax base delivery vehicle. We'll have our cost 140,000. Accumulated wear and tear 140,000 divided by 4 multiplied by, we know that we have to take into account the months now because it's apportioned. From 1 February 2018 up to 30 June 2018, that's 5 months. 5 months. 1 February 2018 to 30 June 2018, it's 5 months. So multiply by 5, divide by 12. What do you get? Thank you. 14,583. Thank you, guys. Right, then we get our tax base. So your tax base will be the value of the asset according to SARS. That's 125,417. So this will be 125,417. Then our temporary difference 8583. Then our deferred tax 8583. We'll just multiply by 28%. What do we get?
Two four zero three.
2403. Right. So to come here, our carrying amount is more than the tax base. So that's a liability. So negative 2403. Right. Then we find our total. Since it's negative, that's a deferred tax liability. All right. Any questions? No questions. Right. If we don't have any questions, then we'll continue tomorrow. So I will send the recording later today. Right, Imtanden.
Yes, Eugene. So this is a deferred tax calculation. So if they wanted or if they asked us about the deferred tax, I'm saying this calculation B is a calculation for the deferred tax balance.
Yes.
So if the question asks for the deferred tax notes, which amount are we gonna put in there?
Yeah, that's my first thing tomorrow.
Oh, okay.
Actually, remind me tomorrow that I should do the note tomorrow.
Oh, on deferred tax, okay.
So that I can show you that if they can ask for the note, how do we do that?
Okay. No, thanks.
So please, tomorrow would have to do the note.
Okay.
Right. Okay, thank you so much, guys. So we'll continue at 10. Please remember that you also have to know the concepts from the previous topics, because according to them, the topic can examine on anything, including the topics that we have done. But I foresee them mainly focusing on these three topics of PPE, the investment property, and the fair value adjustments. But just make sure that you are also practicing. Because of time, I can't go back to the other things. So be alert on them also. Okay, thank you so much. Have a blessed Saturday. We'll meet tomorrow. God bless you richly.